We're joined by Sir Andrew Large, former Deputy Governor of the Bank of England. You're an INSEAD alumnus. You're talking here this evening to INSEAD students. The Fed is pumping money into the economy, $600 billion in terms of quantitative easing. What sort of impact do you think that will have?
Well, I think that's one of the questions no one quite knows. So there are really two things going on here. One is no one's quite sure what impact this will have in the States. Clearly, from the point of view of the Americans, this is an attempt to reignite, if you like, the development or growth of the economy. But equally, there are questions being raised outside the States because large amounts of this liquidity will end up looking for a home, and that home may well be in emerging markets where we've seen very big increases in reserves. We see questions of whether currencies should or shouldn't be revalued and all these things. So these two things are interlinked. So it's clear that the Americans are doing this in the interests of the US economy. I think there's a certain amount of uncertainty as to how successful that's going to be.
Well, there seems to be almost a consensus view at the moment that it may be ineffective, but do you think it will essentially keep the dollar pegged lower?
Well, I think that is definitely an implication, and although of course the Americans would say that that isn't a deliberate intention, I think it stands to reason that the currency is likely to be lower than it otherwise would have been as a result of this.
What's your view on currency wars? There's been a lot of talk on that.
Well, it's all tied up with this, really. The Americans obviously would like to see the renminbi significantly stronger. It's all about jobs in the States, effectively. The Chinese, on the other hand, are concerned in two senses. One, I think they themselves are the recipient of a large amount of the liquidity that's being created. But the other is that if they were to revalue the renminbi too rapidly, it could give rise to social unrest in China itself, and they clearly are very worried about that. So you have two points of view here, and it's very difficult to know how to reconcile them. To a large extent, I think it's a matter of timing. There's little doubt that the Chinese can see the validity of the argument that over time the renminbi should adjust. Equally, they need time to make sure that the social cohesion can hold together.
Also, recently we've heard Bob Zoellick of the World Bank talking about a gold standard. Do you think that's feasible?
Do you know, I don't know the answer to that. I would think probably not. I mean, I think there seem to be two variants. One is that one reverts to something that would be the gold standard as such, and I don't honestly think that many people think that that's very likely, including, I suspect, Bob Zoellick. The other is that gold should somehow be one of the contributors to a basket, if you like, of currencies, which might include gold. If you like, that's a less extreme solution. But even there, I've got significant doubts as to whether this will really take off.
There's also been a lot of coverage of Basel III and the capital requirements that will be increased for banks. Do you think that's going to have an impact on borrowing and trade financing? Is that a concern?
But to be frank, I think there's been far too much debate and discussion on these types of regulatory issues. I agree they're important, but they're not going to solve the problem, and Basel III is not going to solve the problem. I mean, underlying it, the problem has been that there has been too much liquidity, which has given rise to too much leverage in the economy and too much debt being created. Now, I can certainly see that under Basel III, the fact that banks would be required to hold more capital is a positive step in terms of mitigating some of the dangers. But I think that beyond that, other measures will have to be taken to make sure that we have a systemic situation that's more secure.
What sort of measures?
Well, I think that there needs to be a policy framework to handle systemic issues, if you like, alongside monetary policy. People have got used now to the fact that monetary policy frameworks exist, and they've been relatively successful in securing price stability. The problem is that although monetary policy has secured price stability has not secured financial stability. And to secure financial stability, I would advocate the need for a parallel policy process to be put in place. Now, the question then is, what would the policy instruments be? And there are many that you could use. You could indeed use additional add-ons of capital beyond that which Basel is asking for. Equally, there are other things you could do. You can have loan-to-value ratios if you feel that there's too much lending taking place in the housing market. In some of the emerging markets, maybe you have capital controls of some sort or another. There are a variety of different tools and instruments. But I think that it's time that politicians and public policy makers develop the confidence actually to put these types of policy frameworks into place.
But is inflation really a concern in the US? Even with printing of money, inflation at the moment is only at around 1%.
Well, I think there might be those who rather naughtily might even feel that if you were to have a little bit of inflation, it would reduce the burden of the debt that you otherwise have to repay. I'm certainly not advocating that, but it might well be a twinkle in a few policymakers' eyes.
Is the Fed making the right sort of moves at the moment?
Well, we've talked about quantitative easing, which is all being done in the name of price stability and retaining price stability and developing growth. I have some reservations, as I said before, about quantitative easing. Equally, I can see why they're doing it. If the question you're really getting to is, will quantitative easing lead to inflation, the answer is maybe. On the other hand, I don't think one should overlook the fact that the Fed can easily reverse the policy stance if they think that inflationary expectations are rising too quickly. So I don't think that just because they've done this, it means that inflation's an inevitability.
But Germany is seeing the Fed's action in terms of quantitative easing as printing money, and they recall the times of the Weimar Republic when printing money led to hyperinflation.
I think that's indeed one of the reasons, and it's seared in the German consciousness, and I think one respects that. I think that the Germans are right to point out the dangers. Equally, I do think that the dangers are perhaps slightly overstated, given the possibilities the Americans have to withdraw the stance they're taking.
What's your view on economic recovery? Are we out of the woods?
I think the basic point to think about is this, that the mature economies, in particular in America and Europe, frankly, the growth that they have produced over the period up to 2008 was, to some extent, I would suggest, illusory. It was based on a growth of debt, and beyond a certain level, that debt has risen to an extent that it's going to have to be clawed back, because without doing so, the danger of further financial crisis of one sort or another is going to remain. So, if you're going to claw the debt back, then that will inevitably have an impact on growth. A way of putting it is this: I've heard it argued that were it not for the crisis that took place in 2008, economies like the United Kingdom would be 10% higher today than they presently are. That may be true, but I would suggest that the starting point was already 5% too high, and therefore, yes, there has been a reduction of GNP below the sustainable rate, but it's nothing like as great as it otherwise would have been, and it's possible that we've still got to endure some further pain of getting it back to a sustainable level.
Given the problems we've been seeing in Europe, in Greece, Spain, Portugal, Ireland, and given the debt problems that we've seen and their impact on the euro, in Germany there seems to be something of a groundswell of opinion now in favour of a return to the Deutschmark. Was the UK right then to stay out of the euro?
Oh, look, that's a very big question, the whole euro question. Clearly, the risks you take in creating a currency union are greater if you don't have a fiscal union, and there is not a fiscal union in Europe. The Stability and Growth Pact didn't provide it, and so now there's great effort obviously being made to develop a proxy for fiscal union, because without it, ultimately, currency unions do run into difficulty. I think one of the deep down, quite apart from the rather parochial reasons that the British may have had in terms of keeping out, deep down, I think their real disquiet was because they took the view that, look, we ourselves cannot see our way to being part of a fiscal union. If we're not going to be part of a fiscal union, then we think the risks of being involved in this may be greater than makes sense. So I think there were two sort of basic reasons. One was very parochial, but the other, I think, was more deep-seated.
As I mentioned earlier, you're going to be speaking to the INSEAD MBAs. What would your advice be to those considering a career in banking? Is it a good time to be in banking?
I think you want to distinguish between what you mean. There are many different types of banking. I think that the word is bandied around now as being, you know, a bad thing. But if you come to think of it, the banking world consists of two different types of activity. One is the development of means of conveying liquidity or savings, if you like, from one part of the economy to another. And the other is the more proprietorial aspect of making money through trading and other types of proprietary activity. I would say that if you look at the banking world today, that former area is just as vibrant and just as important and just as interesting for people to go into as it ever was, perhaps more so, because the requirements for finance are ever growing, the imbalances are there, the money is in one place, it can be needed in others. I think where I would exercise a word of caution is in the get-rich-quick area of proprietary activity, which to a large extent, I think it's fair to say, has been based on certain aspects of understanding and knowledge haven't been widely available, and therefore, putting it rather bluntly, money's been left on the table. I think that is an area where I would counsel a certain amount of caution.
Sir Andrew Large, thanks for joining us.
Thank you very much.